Real Estate Radio Live, an informative and engaging podcast discussing everything you need to know about the world of real estate. Your host, Joe Cucchiara, provides you with insight and guidance on how to buy, sell, finance, and invest in real estate. He also offers real estate tax management strategies, new construction advice, home improvement tips, and much, much more. And now, to guide you around the world of real estate, here's your host and Real Estate Radio Live team leader, Joe Cucchiara.
Welcome in, Joe Cucchiara with Real Estate Radio Live. Thank you again for those that are continuing to follow the show and keep up to date with us and reach out to us, contact us. We appreciate that very much. Just a reminder for those that are just checking in and may not have listened or followed the show for a while, been over 12 years and over 1,700 shows now. Proud to say it's been a good run, and we have been fortunate and blessed to have many great guests, information, and much, much more to share with you, the audience, over the last several years. And we'll continue to do that. Just a reminder, the focus of this show is education and information. So what I try to do is work really hard with my content, philosophy, feedback, etc., along with great guests to provide you, the listener, with education and information to help you make wise decisions in and around real estate and lending. Pretty simple. That's what we try to do, and provide that content with you, or to you, or for you, as I should say, on a regular basis. So we'll continue to do that. Today, we're going to talk about closing out the third quarter and what maybe to expect in the fourth quarter and going forward as it relates to real estate and mortgage and financing, a little bit about interest rates as well. And just a reminder before we get started on the show, for 12, 13 years on radio and podcasting, and 24 years now, close to 24 years in mortgage banking and mortgage financing. So that's what I do. And just as a reminder for those that may need help or assistance in purchasing a home, refinancing a home, maybe restructuring debt, any of those things like that, I could help you do that. We also have a great network of vetted professionals as part of our crew here. And if you are looking for a professional real estate agent that really understands the market, the business, let me know. We're happy to refer those to you, just as we would any CPAs, financial planners, and tax advice, any of those things, builders, home design. We have a whole complete network of professionals that have been vetted again and have been working with us for 20 plus years. So we're happy to help you with any of those people that may need to serve your needs. All right, let me jump in a little bit about the housing market and some of the challenges we're experiencing, and we'll start first from a kind of a national level and national overview of my view on the housing market, and then kind of zoom back in maybe to the Bay Area, talk a little bit about the Bay Area, and wrap up with interest rates and what we might think interest rates might be doing anytime in the near and distant future. So just to talk about housing, just to bring you up to speed, most of you may or may not know that we have a housing shortage. So it's real simple. It's a supply and demand. Economics will tell you when you don't have enough supply, but you have people clamoring for the demand, there is an issue. So what we have right now nationally, really just about everywhere in the United States, is a supply issue. We have inventory. We have low inventory with housing, which means people just have less opportunities to choose, less choices. And it's just real simple. Again, I'll just have to say it. Just common sense is we have millions of people looking for homes plus that amount, and there are just not enough houses to go around. Inventory is low. So one of the things I want to talk a little bit about, why is inventory low? Because this confuses some people, and it should. Because normally we have kind of a recycling that takes place every 5 to 7 years in real estate. I've been doing this a long time. And so typically what happens is every 5 to 7 years, we have a bit of a recycling, which means clients, people, consumers are buying up, selling properties, buying up, or maybe what a lot of people will do is buy their first or second property and maybe turn that into a rental property and then buy another home as their primary residence. So there's been a lot of activity over the past 20 years like that. So one of the dynamic changes over the last 4 to 6 years has been the major purchases from major hedge funds and investment banking operations and investors. So As of now, the most recent statistics would tell us, which is really alarming and amazing. So 1 out of every 5 properties is owned by an investor or a hedge fund. These investors, mega investors that come in and buy thousands and thousands of homes all at once sometimes in blocks of 10, hundreds, thousands, it depends. The bottom line is you have 5 of the top hedge funds in the United States, okay? 5 of the top hedge funds in the United States represent and own 60% of the investment properties out there. So that'll tell you what's happening right now. And the reason why we have a bit of a logjam and the reason why we have a shortage is because houses are not being cycled. We're not going through a cycle where, see, because you have so many properties owned by hedge funds and investment groups, they're hanging on to these thousands and thousands, in many cases, 250,000 plus over 1 million houses are being held on to each and every year, and that is building. And they're not unlikely going to sell them, or they don't sell a lot of them at a time unless there's a reason to do it. They're holding on for them for investment reasons. They've bought them, and there's such a demand for rent, and rents keep going up. So these investors have bought blocks of homes. And this is one of the main reasons, ladies and gentlemen, that homes are not moving as quickly or as rapidly or in a cycle that we're used to every 5 to 7 years. And then we don't have much inventory. So this is one of the major problems. So now that we've identified it, the question is, how do we solve it? What could change? Will anything change? Well, I'm going to talk a little bit about a topic that some people may not be too excited about, and some people may want to try to avoid, and some people may even want to say it's not going to happen. But I will say this, I do think that sometime in the next couple of years, and it could happen as soon as 6 months from now, it could happen anytime between now and 2 to 2.5 years, we are going to have a major correction in the housing market. And again, when I say that, I'm not saying it to alarm anybody as much as to educate you. And so the first question is, why do I think that? How do I think it? How do I have that information? Why am I thinking this? And why am I delivering it to you today? Well, because doing this for 24 years, I continue to study and look at cycles and trends and things that are taking place. We also track data like income. How is the income race paced with the home appreciation and value? One of the biggest indicators we look at is how much is income increasing as it compared percentage-wise to the appreciation in home values that have gone up. Well, it's not even close. So what I mean and what the example is, home appreciation and the values of home are growing like a rocket ship and going up so rapidly as it's impossible to keep up with the pace of the average income of the household incomes. So when you have this happening and when you have it really out of touch with reality and there's no safeguards, there's no firewalls, there's nothing to stop this from happening at the moment. But I will share with you what I think what will happen pretty soon. So we have this dynamic where homes are appreciating at tremendous values. People are excited that own properties because they're seeing their assets go up and they're seeing the value of those, and that's exciting. We all know that's exciting. The downside to that is that every time these homes appreciate 5, 10%, then you take an element of the purchasers out of the equation. You take an element of people that can no longer afford that home. And in order for this to somehow come back to somewhat reality, there is going to have to be a major correction. There has to be. And again, I'll go back. I'll live by these words. I don't know if it's a year from now, 2 years from now, sometime within the next 2 to 2.5 years, I believe, strongly believe, there will be some kind of major correction in the marketplace in all of housing. Now, it's going to hit certain sectors different. It could hit what typically happens, it will hit the areas, the vacation areas, the secondary home areas, vacation homes, it'll hit those areas harder. And the reason why is because they don't have the strong employment that we have. Let's say, for an example, in Silicon Valley, I always use Silicon Valley here because we have such strong employment and such high income earners here. So even when you take a hit in the marketplace, and even though there's a major correction in values in Silicon Valley, they're going to come down too, but there's two things that are going to happen in a place like Silicon Valley. They're not going to come down as far you're not going to have as big as an adjustment downward in a place like Silicon Valley than you might like a Montana or an Idaho, or in some cases, Nevada and some of these places. That's the first. The second thing is they don't have the income to support that. So what'll happen is, as compared to, let's say the Silicon Valley has a correction and we correct 25 to 30%, the average home, maybe, and again, just sake of conversation, it's $1 million. Now that home is worth, say, $700,000. Now, what'll happen in places like Idaho, Montana, Nevada, places that have overgrown and oversold second homes and investment properties, they don't have the sustainability of the high income earners. They don't have, I should say, the percentages of. So what happens is in markets like that, you'll see a bigger downturn. You'll see a correction of maybe 40 to 50% in some cases. And I'm not saying this is going to happen all over the place, but it will happen. It just will. And you might say, Joe, how are you so confident that's going to happen? I'll tell you why. Because at this pace, there is no way the average or above average person is going to be able to afford a home if we keep this pace of appreciation in home value. It has to stop. It has to correct. And again, some people would say, no, Joe, we're done with the mortgage meltdown. We're done with the .com. We're done with this. We're done with this. It's a different market now, Joe. And I would say, well, sure, it's a different market. To a certain extent, it's a different market. But what I'm going to tell you is it's going to happen. And you just, instead of emotionally looking at this stuff, you have to look at it by the numbers and the data, statistics, take the emotions out of it and really think about it. Okay. If you have an average, let's just take Silicon Valley again, and I'm just using examples. I don't know this to be true. So if you have now, let's say a household average income in the Silicon Valley for 150,000, let's just say, okay, for example, and it's 150,000 and the average home is $1 million. Okay, there's a bit of an issue there, but they might be able to stretch it out, put 15, 20% down, and this gets close to working. Okay. Now let's fast forward 3 or 4 years, and this is the kind of locomotive we've been on. All right. So let's say we fast forward 3 or 4 years, and now the average income has rose a little bit. Instead of 150, it's at 170. Okay. So now the household income average is at 170. The problem is that $1 million home 4 years ago is now 1.4 million. And so you have an element of income earners that are completely removed from the fact that they could buy a house or not. They won't be able to afford a home unless they have some huge down payment. But if we just take an average 10, 20% down, the average person making that amount of money will no longer be able to afford a home at 1.4 million. They won't. And this is what's happening. This is exactly what's happening. Now, in a place like Silicon Valley, we're a little bit jaded. And unfortunately, we're in la la land to a certain extent because we think this is never going to stop. We think that people are going to keep making a ton of money, and we think that homes are going to keep going up. I will say this, we will have a correction. No one could tell you when. So I'm not going to tell you when. All I can say is my best guess is when we look at the data, statistics, and what's going on, we think it's going to be sometime in the next 2 to 3 years. Or I do. I really do. And not just to say it, it's the information I'm providing you right now. It can't sustain. It won't sustain. And let me tell the other element this of people don't really take into consideration. Guess who wants a correction, but they won't tell you they want a correction? I'll tell you who wants a correction. Fannie, Freddie, the government agencies, HUD, anybody in charge of the ability to have home affordability or homes more affordable to more people want a correction. Why is that important to know? I'll tell you why it's important to know. It's because they could pull some levers. They have the ability. They have the wherewithal to stall the market. They have the wherewithal to get us into a market correction. Someone might go, Joe, why would they do that? How could they do that? Well, the why is just what I just got finished saying. The why they would do it is because they're nervous and they are getting screamed at and yelled at by constituencies and everybody else saying, this is ridiculous, you guys. We can't sustain this. There is no way anyone at a rate like this, if you want to have any kind of affordability process in home ownership, that it's going to take place. So this is why they have to make the changes, because they want more people with the ability to buy homes. Everybody does. The government does, HUD does, Fannie Freddie does. It is the machine that runs the economy. So the more homes bought, better. And everybody's more happy when you have a more affordable process where someone doesn't have to make $250,000 a year to buy an average home. And that's what it's come to in many cases, if not more. So that's why. So the next question is, Joe, how would they do this? How would they pull the levers? How do they have the ability to get us into a correction? Well, they could quit buying mortgages. They could take liquidity out of the system. What's interesting is they tried to do it by raising interest rates. That's not changing, right? I mean, interest rates, because inventory is so low, and what I talked to you earlier about the investors holding on to these properties, somehow they have to pull the levers and make decisions that's going to get those investors off the fence selling homes. Yeah, that's what it's going to take. So I could tell you right now, most people don't know this, but back in 07 and 08, before the big crash, that was about it. There's written documents, not just, this is not hearsay. There are notes, there are minutes from meetings with the Fed and everybody else talking about how do they get the market into a correction mode. That's right. They're discussing back then, before the big meltdown, how do they get the market in a correction mode so we can make homes more affordable? It's true. So fast forward, here we are, 2024. Affordability is suffering big time, more than ever before. They do not want it to get to a situation where only the rich or only the wealthy could afford homes. And in some cases, you're really getting to that level. In some areas, you're getting that level. So the government wants to stop this. They want to put a slowdown to it. And I could tell you that I feel strongly about this. In the next couple of years, we're going to have a correction. Now, again, those corrections could be different in different areas. I mentioned before, anytime you have a high growth and job, or an area that is high income earners, again, like the Silicon Valley, and there's other places, certain parts of Austin, Texas, New York, Boston, there's certain places that have saturated areas of a lot of income and a lot of employment, or high income, I should say, and a lot of employment. Those areas aren't going to suffer as much. The areas that are going to suffer quite a bit are the second home markets, investment properties, and those areas that don't have the high income earners. Those are going to come down quicker. It just happens. I don't know if you guys remember this. I do, because I was in this business. I'll give you a quick example, and this is just in areas we know about. When we had the meltdown of 07 and 08, I remember it clearly because the home at the time I bought in 2005 for 1.3 million. And right around 2008, 2009, that home was probably worth 800,000 at one point. In other words, it came down. It was below $1 million, 850 to 900,000. Did I panic? No, because it was my primary residence and I knew I was going to be there. So I didn't worry about it. I shouldn't say I did worry about it, but I wasn't going to walk away from it. And thankfully, I was able to not walk away from it, but a lot of people did. Fast forward, that home is now worth $2.4 million or so. The reason I bring that up is if you take that same situation, and I remember this to like it was yesterday, it's kind of scary. And if you looked in the Central Valley, I remember places like Stockton, Lodi, and places like this. Let's say the peak in those neighborhoods were, I just told you, I bought a place, in Willow Glen in 2005, 1.3. Let's just say we're in Stockton and Lodi at the same time, and someone bought a place for 800,000 in 05. 800,000, kind of the peak of the market. Let's just say, for example, right? That home came all the way down to 300,000 to 400,000. That's right. 50, 60%, and even more. It was devastating. I remember. I remember there was investors out there, there's people I know. And the reason I bring that up is that the reason why that $800,000 home just didn't drop, to say 650 or 70 or 5 is because they don't have the job strength out there. You don't have the job market to support a number of homes at 800,000 or higher. So all of a sudden, that number has to come down and just more congruent to what the income levels are in those particular areas. And because the income levels are lower, those home prices are going to come back down, and they're going to keep coming down until the majority of people at that income level in those specific areas could afford homes. This is what happens, and it's going to happen again. And I believe it is. And it has to for the reasons I just discussed. It really does. Again, I'll say in the next couple of years, what does that mean for people that own properties? I own properties, but if I was someone that owned several properties or hundreds of, or, about 15, I don't know, I would take a real strong look and see what your portfolio looks like. What kind of financing do you have on these loans? What kind of liabilities do you have? If you don't have any loans on them, then that's one thing. Or if there's low debt on it, that's another, thing to keep in consideration. Or maybe you take a little bit off the table. Maybe you sell some of these the next couple of years, or sell some of these and repurchase. Or I know it's difficult with investment properties because you have 1031 exchange issues. It's not a situation where you could sell today and say, oh, you know what, I'm going to put this money in the bank for the next 3 years and wait for the market to correct. Now, you can't do that. So it becomes a little more difficult with people with investment properties for sure. But I would just keep an eye on this and know that we will have a correction. And I believe it's going to be in the next couple of years. It just can't keep pace. It's plain and simple. I know a lot of us think that they say, Joe, people were saying this 10 years ago and look at home values. Yeah, I know that. But let me also tell you something. There was corrections, though. If you look back in the history, there were always corrections. And they happen anywhere between 7, 10, 15 years. It's hard to say sometimes. Economic factors, wars could take place. There's different things that we don't know about or potentially don't know that could drive these markets to a certain way. But it'll happen, really. And we'll come back. And, I'm not, when I say, I don't really show, when I say, some people say, well, I hope I'm wrong. I'm not sure. When I say I don't think that way, because it's not that I hope I'm wrong. It's not a terrible thing. Now, some people would say it's a terrible thing. Joe, what are you talking about? I want to lose 30% of my value. I'm not saying it's a good thing for any of us. Don't get me wrong. I am saying that the government would argue with you and other people would argue with you, say, wait a minute. It's easy for you to say because you've owned a home and you had the opportunity to buy a home when it was more affordable, and it's not affordable right now. So we need to make housing more affordable. And that's what the government, and that's what a lot of these agencies are after. And I can tell you that they won't stop coming up with ideas and strategies and planning until they get some kind of a correction, because they want housing more affordable to more people, plain and simple. All right, I'm going to talk a little bit about interest rates now and maybe what we have going now, what to look forward to in the future. Most of you know that we all benefited back in 2020 and 2021 from historic low interest rates, 2.5%, 3%. It was great. A lot of people, this is another issue why housing is not moving, because we have millions and millions of people that have interest rates and, the below 4%. Let's just call it below 4%. And so when you're looking at that interest rate, if you're a homeowner and you have a 3% interest rate and you're looking at that and you're going, God, that looks great. And then you're thinking, God, I'd like to move up though. It's time to buy up. I'd like to sell my house and maybe buy a bigger home. And we're thinking about having more children, or, we want a bigger place. We want to move to a different area. We want to relocate, whatever. But it's hard because then you look at that 3% interest rate and you think, God, I don't want to get out of that thing. I mean, how do I get out of the 3% interest rate? I know all these other things sound good, but man, wow, rates at 6%, 6.25%. Do I really want to do that? So this is another dynamic. This is the reason why we have low inventory right now. People are reluctant to pull the trigger and get out of those 3%, 3.5%, below 4 interest rates. That is another equation. That's part of the problem that we are faced with low inventory because of that. So the other piece of this that I'm seeing a lot that I wanted to share with you today is that at the same time, many of us have record low interest rates. I will tell you at the same time, statistics tell us, and again, this is not me, this is real, that we today, as I do this podcast today on October 14th, 2024, we as consumers have never accumulated so much debt in our lives. That's right. Right now, in the United States, consumer debt is at a record high. I'm not sure that we ever know a point when it's been higher than this, but it is a record high. And what does that mean? And how do we get there? Well, there's a couple of reasons. One, there's many people that are struggling in the economy. I know some people would say the economy is doing great, but a lot of people would argue with you. For the first time, high tech's laying off, reducing wages, cutbacks, part-time, a lot of different things are happening. Stock market's going crazy, that's for sure. But listen, the other reason why the debt is so high and it's accumulated because some of those people out there looking at that 3% interest rate, and then they go to borrow money on a home equity line or a personal loan or an auto loan. And let's just take a home equity line to begin with. So a home equity line rate right now is between 8 and 9%, depending on a few factors. Millions and millions of people have accumulated debt, and part of the reason they have, and they still hold that debt, is because they don't want to get rid of the 3% interest rate. That's right. I can't tell you how many hundreds of people I've talked to that have this low interest rate on the first, but they've accumulated record debts on home equity lines, credit cards, personal loans, student loans, different things. And they say, Joe, I don't want to touch that 3%. I said, right, but you realize what you're doing? What do you mean? I don't want to touch the 3%. Right, but let's just say you have a $300,000 loan at 3% in first position, and then you have another $200,000, $250,000 on an equity line, and you're paying 9% for. I know, but I don't want to touch the 3%. I understand that, but the math doesn't work. You could consolidate those two and go to a 5.5%, let's say 6% interest rate even, and save money. You're paying high interest on non-deductible debt. At least mortgage, you have a tax deduction with it to a certain extent, depending on your loan amount. You don't with these other things in some cases. So these are the factors, these are the reasons that we had all-time record high for debt. People are afraid to touch those mortgage rates. So when do I think that's going to change? My belief is when we get the rates down into the fives and maybe high fours, certainly high fours, low to mid fives, I think we're going to have a flood of refinance activity. The reason why is people are holding on to record debt. But when I say record debt, think about that. Home equity lines at 8, 9, 10%, credit cards at 24%, personal loans at 15 to 20%, auto loans, who knows? Record debt. Ladies and gentlemen, again, I'm not making this up. This is real. This is real. And this is the other factor. Between these factors that we'll be faced with, or the reason why the housing market is struggling the way it is, there's very little activity. There's paralyzation in some extent with what I was just describing. Again, real quick math. If someone has a $300,000 mortgage at 3%, they're feeling good about that. And then they accumulate $250,000 on a home equity line, they're paying 9%, right? So it doesn't make sense to keep that $250,000 at 9% ongoing. Now, if you have a plan to pay it down or pay it off in a couple of years, then I'd say perfect. Then I wouldn't consolidate. But if you don't, every month you're paying 8 and 9% interest on a $250,000 loan. And remember, that's an interest-only payment. If you're making the minimum payment, you're not touching principal, which is even worse. This is what people are faced with. So there'll be more activity again when these rates come down. My prediction is they got to get back into the fives, typically the low fives, and you'll start seeing a lot more activity. Someone might say, well, when do you think that'll happen? It'll happen sometime next year. I don't know when. I would say the first or second quarter. We could probably see interest rates back down in the low fives by the first or second quarter next year. I would hope it does, hope it happens sooner, but that would be my best guess when it comes to that. So anyway, I'm about ready to wrap things up. I hope you enjoy the information. Again, I will say just a recap. I don't share this information in hopes to make people panic or make you nervous. I share it because this is what we study. This is what I review this markets every day. I focus on real estate and lending and some of the economic factors around it. So I'll share that information with you as I get it. I do think there's going to be a market correction. Remember, if I could help you analyze consolidating debt, that's what I do. I'm in the mortgage business. If I could help you consolidate debt, if I could help you prepare for a purchase, a refinance, whatever it may be, let me know. Maybe it's just a conversation to find out. Do a mortgage evaluation. What's your mortgages like? Does it make sense to consolidate debt? Does it make sense to buy up? What if you bought up and rented your home and instead of sold it? I could do all those analysis for you. I'm happy to help you with any of that. All right. Keep in mind, if you want to reach me, it is area code 408-838-9060. That's area code 408-838-9060. Or you can email joe@𝗓𝗡radiolive.com. That's joe@𝗓𝗡radiolive.com. And lastly, as a reminder, we have a great network of professionals. If you need a good real estate agent, CPA, financial planner, home design, contractor, any of those things we could help you with, just give us a contact, give us an email. Thanks again for those that email and call me during the week. I appreciate the questions and your business. And we'll look forward to another podcast next week. Until then, I hope everybody takes care and be well.
You've been listening to Real Estate Radio Live. For more information on today's program, visit 𝗓𝗡radiolive.com. That's 𝗓𝗡radiolive.com. Subscribe to our podcast. Discover more at 𝗓𝗡radiolive.com.